Hello and welcome to another Finax podcast. My name is Tamara and this is my colleague Šimon. Šimon, hi.
Good afternoon to everyone.
Welcome to our podcast in English. Šimon is our financial analyst, and today we'll talk about intelligent investing. So, Šimon, in few words, what would you tell us? What is intelligent investing?
Intelligent investing, apart from denoting in general investing that we considered smart and intelligent, is the word that Finax, or our firm that is producing this podcast, refers to the crux of a service. So our basic service is usually referred to as intelligent investing. The foundation of the service is that it is a robo-advisory algorithm. That means you fill in a questionnaire, which will ask you several questions about your intending investment, even if you have never heard anything about the world of investing. And our algorithms will recommend a portfolio that is suited to your needs and to your experience based on your answers. And intelligent investing essentially denotes all the portfolios that Finax includes in these algorithms. So in total, those are 11 portfolios split according to different risk levels. We will, I think, later talk more about the risks involved with intelligent investing, but these are 11 portfolios ranging from the riskiest, most dynamic one, 100% equity portfolio, which has the largest long-term returns, offers the highest appreciation over very long horizons. So when you invest for 10 or more years, up to or down to 0% stocks and 100% bonds portfolio. And in between, we have various combinations of bonds and stocks. So you can have 80% stock, 20% bond portfolio. You can have it the other way around. And that is what, in essence, we refer to as intelligent investing. What is important to say about these portfolios is that all of them are passive. That is, we as Finax aren't involved in analyzing companies. We aren't involved in picking which stocks will outperform this year, which will be the next Nvidia, the next Bitcoin. But the portfolios replicate the performance of the entire market. That is, when you invest via intelligent investing, you hold the world economy with different weighing of stock and bond market, and you wait for it to appreciate over the long run. So that is what I would say as the very basic introduction.
Yes, but I think you already basically touched base on passive investing, and maybe we should say a few words about ETFs. What are ETFs, and what is an index, basically?
Sure. Perfect. let me just continue with that. We mentioned the word ETFs. I think not everyone who is listening might know what an ETF is. So let's answer that question first. ETF is a financial security. You might have heard about being able to invest in stocks, invest in bonds, invest in mutual funds. Those are usually things people know about in general. ETFs are relatively less known, but very similar in nature. What an ETF is it essentially...
So it stands for exchange traded fund.
Perfect.
Maybe?
Perfect. Yeah, perfect. Thanks for reminding me. Yeah, ETF stands for an exchange traded fund. Its essence is very similar to mutual funds. That is, it's a fund that pools money from many investors, smaller investors who can contribute as much as they want, buy as many pieces of the ETF as they want. And then the fund buys many securities. So they buy a large pool of stocks of many companies. If it's focused on bonds, they buy bonds of many countries with maybe different maturities, different issues of bonds. They might hold bonds of different corporations. They buy a lot of it to achieve diversification. So ETF by nature is a widely diversified investment, so that even with a small initial investment, even if I have, say, 20, 40, 60 euros, with which I wouldn't be able to buy many stocks.
This is what I wanted to stress on. Basically, if you wanted to buy the whole index, for example, an S&P 500, as a small investor, it would be a very difficult task to do money-wise. So ETFs basically provide us with an opportunity to buy a very diversified portfolio with a very small amount of money.
Exactly. So that is the first advantage and the first reason why we think that intelligent investing portfolios should be, for most investors, comprised mainly of ETFs. Then the second step to differentiate exchange traded funds from regular mutual funds is that the shares or pieces, investments in ETFs, unlike with mutual funds, are traded on a stock exchange, hence the name exchange traded fund, which means that their price isn't evaluated by a depository institution of a bank, or essentially you don't have to contact your bank to buy and exit the investment. You can normally buy pieces of ETFs and buy these diversified investment on a regular stock exchange or on regular organized exchanges, which are places where the trading of securities such as stocks, you might have heard of the New York Stock Exchange on Wall Street. That is where these investments are traded. So ETFs can be bought directly in the market. The market determines their price based on available information and everything that is inside them, and so on. And the last large, and for me, the most important difference to the mutual funds is that most ETFs, although some of them are already have active investment approach, and I think this is a good point to actually clarify to the audience what the difference between passive and active investing is. So you can have passive investing, which is holding the market, as we said. That is buying into the economy or into a segment of the economy. You can buy into biotech companies, you can buy into the US companies, you can buy into the entire world, and you don't make decisions about what securities to include. You try to include all the relevant ones, or most of them, and you don't make decisions about when to buy and when to sell a particular company. When you do that, when you analyze which companies to include in your portfolio, when you try to time the purchases, so maybe exit the market before you expect a downturn, exit from a company if you expect its stock to decline, that is called an active investment approach. That is active because you make many active decisions about timing, about which securities to include, and so on. Passive investing is usually long-term, and you don't let emotions, judgments, your information affect your choices about the investment. So most ETFs are instruments for passive investing. That is why they became so popular. They are passive by usually tracking the performance and composition of a certain index. And that comes to your other question that you had for me, which is, what is an index? So an index is a sample, a
representative
sample of a certain market segment. That doesn't necessarily have to be the global economy, although we, for example, have an index for companies or performance of companies from the developed countries, MSCI World, right? But they can be more specialized. You can have indices of large cap US companies, S&P 500, probably an example of that all members of audience who have heard about investing heard of. You can have indices for biotech companies from Europe. You can have indices for emerging market companies. You can have indices for bond, for US Treasury bonds, for emerging market bonds, and so on. So an index includes a representative sample of securities that have these characteristics that are the target of the index, and it tracks their performance. When they decline, when the market segment declines, the index goes down. When they grow and thrive, the index goes up. And ETFs seek to replicate this performance. That is, their goal isn't necessarily to have a portfolio manager to select the winning stocks. They are trying to track the performance of segments of the economy that their underlying index. We usually refer to that as benchmark. We usually try to avoid complicated terms, but if you ever hear about it, it's usually referred to as the benchmark index of the ETF. That is what the ETF tracks. So ETFs are an amazing tool for passive investing, and that is what we decided to comprise our portfolios of. So the 11 intelligent investing portfolios essentially represent the economy. They have indices for US companies, for European companies, for emerging market companies. They have government bonds, corporate bonds, depending on the specific target allocation. So the weight of the equity and of the bond component.
Yes, maybe if I can just add a little bit on that about, an index being basically a tool of passive investing. And as a matter of fact, without making too many, as you said, active purchases and making too many transactions, it makes them cheap, right? They are cheap, which means that they are basically giving us the highest possible returns when we are tracking the certain market. And it gives us a wide diversification, which is also very important when we think not just short term. I mean, it's difficult to maybe talk about what we can do with our money in terms of short investing, but when we look at something in the long term, we also want to make sure that the ETFs and our portfolios are, I would say, as good in quality nowadays as they will be in the long run. Because when we talk about passive investing and long-term investing, we want to make sure that our portfolios are equally good now as they will be in 20 or 30 years, when we maybe want to really withdraw our money, reaching our goal, as it could be for our pension or something like that. So passive investing has proved to be a very successful investing on the long run. It's when we look at the statistics, it's beating the active investing.
Most of them, yeah.
Yes, by 90-something%. So when we look at the long-term goals, it is a very good tool to use ETFs for our investment. I also wanted to touch base maybe a little bit on the actual ETFs that we use in our portfolios and how we pick them.
Perfect. Yeah. We utilize a combination of strategies when, or let's say of criteria when we were selecting our ETFs. The essential goal is simple. As we said, because holding the market over the long run has proven to grow significantly and a lot, and usually typically beating the performance of actively managed funds. We wanted to focus on the criteria that would boost performance while minimizing risk. So one of the criteria we're looking at is the internal fee of the ETF, trying to get it as minimal as possible, because while return, especially over shorter periods, is uncertain, you will have to pay the fee for sure. So selecting the ones or investment strategies with lower costs, which is what Finax has been trying to bring to Central Europe and to wider Europe from now with expansion getting underway, is a focus on, rather than speculating and trying to earn uncertain returns, which is very hard to do because, as you mentioned, more than 90% of actively managed funds focused both on European and US equities usually fail to even generate a higher return than indexes or ETFs,
especially on the longer run. So
exactly, especially if you invest for 5, 7, 10 years. So that means that you should focus on things that you, as an investor, can affect, right? And one of the things that you can affect that will be a certain boost for your return is to minimize the fee that is associated and minimize the cost of holding the ETF. So we look at fees and try to minimize them. We then select portfolios based on the goal, or ETFs based on the goal, that the portfolios, both the stock and bond components, should somehow reflect the actual composition of the market. So we are trying to hold the global stock market and hold the global bond market. That means that we will include ETFs of all the major components of the global stock market. So you have, for example, 3 ETFs for the US market. We want to cover the European market. We want to cover emerging markets, because when you look at long-term data of decades, you never know which one is going to be the dominant region. For example, during the past decade, the US stock market has been very successful, but that has not always been the case. There have been decades where emerging markets dominated and pulled returns up. There have been periods where the region, including Europe and other developed countries, was outperforming the S&P 500. So we are trying to hold all the major components of the global economy, because you never can predict and never have enough information to see the future and to view which one will be dominant. So having a coverage of the global economy that reflects the actual composition of the components is another criterion of whether we include certain ETFs replicating certain indices, and how much of them we include. It just reflects the actual composition. So
yeah, just maybe to say differently, we have approximately 3/4 of the global market covered in our portfolios.
Mhm.
And also, I think another very important thing is that all these ETFs are ETFs managed by renowned ETF managers. So they are not our own ETFs. And basically what it means is that we are really trying to pick the best quality of ETFs to be part of our portfolios.
Exactly. Then another important characteristic is dividend treatment. There are ETFs that you can refer to as distributing, which when companies, and especially if you're holding hundreds, we have thousands of companies in the portfolio, right?
I think now we have around altogether, I think in terms of bond and stock ETFs, we have 13,000 or above 30,000.
It's intense even. And that means that you will receive a lot of profit distributions. If you hold bonds, those make interest payments, coupon payments. So the fund receives income from holding the securities on a regular basis, and distributing ETFs paid out to the investors proportionally. That means if you have an index and the companies pay dividends, you will receive regular dividend payments from the ETF. Whereas you have so-called accumulating ETFs, which use the extra income to purchase more shares in the companies or to purchase more bond positions, more bonds, more shares. So increasing the position and increasing the value of the ETF and the price of the ETF, and that is its return rather than giving you income regularly. We work with accumulating ETFs. That is what we work with. The main reason was because we at Finax like to think about taxes. We will also dedicate separate episodes of this podcast to tax treatment, because the problem with investing internationally is that each country has a different set of tax rules.
So I would like to say that European market is now one market when it comes to taxes.
It's not, right? It's very fragmented.
It's very far from that.
So we want to prepare, in the future, we would like to prepare a research of useful information and overviews of how tax rules related to ETFs work in individual European countries, so that you as investors can determine, can set your expectations exactly and precisely according to what you can expect in relation to your investment. But for now, what usually unites countries is that they have some dividend taxes. Usually, if you have dividend income, regardless of the security it comes from, you have to pay taxes on the dividend. So by holding the ETF, you would almost certainly have to pay some amount, probably not very large, but some amount in taxes regularly, which is not very convenient. And convenience is one of the reasons why we think intelligent investing portfolios are an amazing choice for most investors and for most people, because it's just, if you want to stick to your goals in terms of money, it can be very exhausting. It can be filled with inconveniences, such as having to fill in a tax form each year. So not only does it make it convenient, but it also reduces the tax burden in general. So that is why we prefer having accumulating ETFs. That is also one of the primary reasons. And then there are some other criteria which are more technical. So I don't want to go too much into detail, but for example, the precision with which it can track or even slightly outperform the index is also a criterion that we use to select a specific fund. Essentially, trying to use all the available information to maximize the return while still not speculating, and having a hugely diversified investment over the global economy to minimize risk associated with individual companies and their individual failures. Which is the simplest terms I can put it in. And but at the same time focusing on the performance of the ETF and on also thinking about taxes. So that is a glimpse into the criteria that we use to
maybe just to mention, so intelligent investing is available from only 10 euros a month, which actually I think says it all when we talk about diversifying your portfolio for a small amount of money. I think it also tells us that nowadays there's no excuse why not to invest. There is no more obstacles like large amount of minimum investment and stuff like that. But we also wanted to touch base on why we believe that intelligent investing is really a great tool for investing, and why to invest via robo-advisor like us and not maybe on your own.
That is a good question, and that is a question we often receive. because when people look at statistics, they often admit that having high fee active funds is not the best strategy to earn superior returns over longer periods, because what we like to say and educate people about is that investing should be a lifelong procedure. Although we offer an intelligent investing is also focused on goals. So when you have the questionnaire that actually asks you questions about your intended investment, you can indicate what the goal is. But there are many goals over life, and we should keep investing for essentially decades. I expect to be investing for very, very long when I'm an old man. I will have been a long-term investor. So you need to stay and earn returns and have a portfolio that will work over such long horizons, as we already mentioned. And so
maybe just this goal-oriented investing, and just to add a little bit, is also helping you to achieve your goal, because once you have your goal set and you know that, for example, you're investing for it monthly, whether it's a more short-term investment or a longer-term investment, it also helps you to basically allocate a certain money towards your goal. And when you want to automatize your finances, it also helps if you are doing it monthly and you know the particular reason why you are basically putting that money on the side. I think the fact that you can have up to 99 goals on your Finax account really helps you
put it together.
Exactly, and think about the goals, whether it's a financial reserve or something really short term, or whether it's something like the usual long-term goals when it comes to pension, or maybe buying a new apartment or a house, those goals which are not achievable over a shorter period of time. And this is why we always say, first of all, setting up your goals, then second, thinking that exactly, you need to be passive, you need to enjoy your life and make money work for itself. Not basically spending too much time analyzing. This is something that I think made investing nowadays much more approachable for everyone. This type of investment is really made also for people who have I won't say no idea, but who don't really know a lot about investing. So it's bringing it's bringing investing to every household, no matter whether somebody is very much financially educated or not. But it's basically allowing somebody to start investing already from 10 euros a month.
Exactly. Just to touch upon that, that's precisely the thing. We might have money reserved for a certain purpose. We know that we're going to buy a house, but it's not going to happen in a year, but it's going to happen in 6 years, let's say, is the target, when we will need to be moving to a bigger house, when we will have saved up for the down payment on our mortgage or similar thing. And now we know that having money for 6 years in a bank account is not ideal, because inflation is going to erode its value if it stays there. But many people don't know where to go from there. What is the optimal risk, right? Exactly. Probably investing into the stock of Amazon, such a large amount for 6 years, might be risky, because there can be an economic downturn in 6 years and erase all the gains, or even get me into the negative territory. So what is the optimal allocation? How many, or what portion of bonds should I buy? What stocks should I buy? Most people, I think, don't know this, and it would be very costly and exhausting to run the calculations themselves, look at historical data.
And they don't even want to know this.
Exactly.
And that's fine.
And that is totally fine. We think that people should be doing the jobs that they love. They spend a lot of time making money, and we wanted to make it convenient for them to determine what the appropriate portfolio for a certain goal is. And that is precisely where our robo-advisor comes to help. So you fill in the horizon, the 6 years, you fill in the goal, you fill in your experience, and it will automatically recommend a combination of bonds and stocks that maximize, based on the long-term data that our algorithms work with, that maximize the chance that you will not be in a loss when the investment horizon is over. So setting the risk of the investment going up and down significantly to the appropriate level that you can afford, but at the same time maximizing the chance that your return will be appropriate when you come to that point, without requiring you to analyze charts, without requiring you to look at your brokerage account and watch graphs and something like that, because we believe that most people sort of even dislike math, right? When I talk with my friends, many of them are, it's not pleasant for them to work with fractions, numbers,
for that
graphs,
matter.
And finance.
If you ask somebody
boring.
Just to have a look and to track their expenses or something,
yeah, that's already stressful, right? And that's already boring mathematics. And we understand that. We think that is okay. We think life is there to enjoy, and that money shouldn't stress us. Money shouldn't take away our precious time. So this helps you set up a portfolio that is appropriate and that is logical based on long-term data.
Yes, nowadays we have technologies and we have the know-how exactly to help people basically invest, no matter what their knowledge and education about investing is.
Exactly.
So this is exactly what robo-advisory and intelligent investing is about. I also want to mention the rebalancing. And maybe why it's important, and it's our in-house rebalancing, and it's another feature, I think, that makes this intelligent investing very special.
Yes, let's talk about it in a bigger detail, because we already hinted at the question a couple of minutes ago, that sometimes people ask us, why not just go through the questionnaire, and then, because we are transparent about our portfolios, you can know what our portfolios consist of. Why not just open a brokerage account at eToro or directly at the broker and buy the ETFs at a lower cost, because Finax has to charge some fees to keep operating. So this is a question we regularly receive, and we can talk about it in a bigger detail now. So one of the reasons why we think it's still better to invest via a robo-advisor than directly, despite, in addition to the automation of the decision about the portfolio and its risk, we also designed a rebalancing process. Now, what is rebalancing? In the world of finance and investing, we refer to rebalancing as readjusting the portfolio actual weights to the optimal allocation. That is very technical. let me get just more into more humane language.
Slowly.
Yeah. Let me get into a more humane language. So let's say you want to have 30% of your portfolio in stocks and 70% in bonds. Now, you will, let's say, deposit 100 euros. So you will put 30 of it into stocks and 70 of it into bonds. The two components won't grow and appreciate and earn the same returns. Bonds usually earn a little less, but are less risky. Stocks usually earn over longer periods, not short run. Short run is random, but over longer periods, they are usually achieve superior appreciation. So after, let's say, a couple of years, you might see that your stocks, that the 30 euros that you put into stocks has grown to a larger amount, or at a faster pace compared to the bond component, which means that now, because stocks grew more, they will have more than 30% of your portfolio value in, let's say, 6 years, right? They might have 38%, and bonds might be a little less than optimal. But what you want to preserve the appropriate risk that is there for you, and to also still have the diversification that you originally wanted from the investment and that is optimal to preserve, you need to readjust it. So we would, as Finax, automatically, once the portfolio allocation deviates by a percentage that was a certain percentage, it's not very important to exactly say how much because it's needlessly technical, but once they deviate too much, we will sell off a portion of the bond component and shift that money into of the stock component, which is now has a higher percentage than needed, and shift it into the bond component to readjust it to the 30 to 70 allocation. We also do this between individual components of the stock and bond component. So if the US companies are now too large in value, we will sell them off and buy, let's say, more European and emerging market companies to preserve the optimal allocation that reflects the actual composition of the global stock market. The reason why we do this, apart from preserving the risk that is appropriate to you throughout the duration of your investment, which is important, we also found by running long-term calculations that this enhances portfolio performance. It adds around 0.4% in euro terms when you look at the
more
portfolios.
conservative and even 0.6 to more dynamic portfolios. So that's the range.
And per year.
Yes.
That's
so I think this is also maybe something that we want to talk about is in terms of taxes. So we try in most of our markets so far, we were optimizing this rebalancing. So now with this new takeover, and as we said, with all the possible tax regulation in different countries, it will be a little bit different, but we are trying to tangle that as well.
But this is the idea.
Yes. What I wanted to say is we basically touched it now a little bit, saying that this rebalancing is enhancing the performance. So basically it's giving you an edge on top of the normal performance of the indexes. What does it mean in terms of our fee? And let's talk about the fees. I think this is an important topic also to maybe close the podcast with the subject of fees in Finax.
Exactly. So the basic fee the basic fee for the 11 intelligent investing portfolios with various risk levels that we talked about now, including the Slovak VAT, is 1.2%.
Yearly.
1.2% per year. It's charged on a monthly basis. That is, you split it by 12 and it is deducted on a monthly basis from your account. Sometimes we receive questions. This is a fee that essentially makes us sustainable at this point. There is a long-term commitment to reduce fees, which has already happened in the past. For example, when Finax was created, because we had a smaller scale and needed sort of an extra fee to sustain ourselves, we also
basically had less assets under management.
Exactly. So we also had to charge a fee on deposits. That was abolished a year ago.
Is it already deposits up to 1,000 euros. It was abolished in July last year.
Exactly. So there is already a precedent, and there is a commitment to keep doing it over the long run if it's healthy for the company. But if you want to, sustain your portfolios over the long run, which is when passive investing works best, then you also need to think about how to keep people educated and how to keep the business healthy. But what is important, this is the basic fee. We also have reduced fees. So for example, in our other podcasts, you will hear about the Pan-European personal pension product, which has a reduced fee, basis 0.72%.
Yes.
Yeah. We have conservative products, Intelligent Wallet and Smart Deposit, which are much less risky and replicate the interest rates and yields of short-term bonds in the economy, which only have 0.5% annually, including VAT already. So for some products, it is also reduced. We also have the Finax Elite program for families and clients who hold over 100,000 euros in Finax. That is reduced.
0.85. Yes.
0.85. But that is including VAT, or?
No, it's plus.
Yeah. You have to, just to make the note, because sometimes people might come in complaining about this information. But what is important, what is the crucial point is that you can reduce all these fees even from these baseline levels. That is one of the first advantages that people often don't know about, and that we think it's a pity because they can be very good for your investment setup. So we have several discounts that can help you, especially if you're getting started with investing, that can help you in the initial years of your investment decrease the cost significantly. We have a friend referral discount, which means that whenever you refer a friend, you have your account, you can send an invite from our app or from the online accounts overview. And whenever you refer a friend, then the friend opens an account via your referral link that you can send to them on WhatsApp or Messenger or whatever you prefer. Whenever they open and activate their account, then both you and your friend will get 1,000 euros managed free of charge, essentially.
Yes, for 3 years, yes.
For the first 3 years.
It is also possible to entirely give away this discount to your friend if you
So they can get 2,000 euros managed.
So you can choose their options about this. Then there is a transfer discount.
Yeah, investment transfer discount. So whenever you hold your investments in competitive products and you're dissatisfied either about the performance, that you've had money there for several years and it's not going as you expected, or you're frustrated with fees, or you're frustrated with a lack of communication, which is also completely understandable. And that's the reason why we do so much communication. Whenever you're dissatisfied, you can terminate your investment there and transfer the funds that you held in a competitive product into Finax. That can be a mutual fund, that can be an individual stock portfolio at eToro, that can be even a property, investment property. We accept a large variety of asset classes.
Yes. If you do it within 30 days of selling off your previous investment, you are entitled to this discount. It's 50% of
the transferred
amount for 2 years.
Managed free of charge. So basically halving the fee. And I think this is an amazing advantage, one of the best ones for me and for my friends who are of my age, because especially if you're getting started out with investing, or let's say you will have a portfolio of a couple of €1,000 in Finax, which for many of my friends is the state at which they are getting started with Finax and the investment that they intend for their goals in their life. Having a referral discount, you essentially have to refer 3 friends to get €3,000 managed free of charge. And for many people, that can be the entire portfolio.
Yes, and basically we have quite a few clients who have zero.
Exactly, who have zero fees.
Yes, zero fees. And I think on average, our clients, so overall, have now 0.8. Basically, so I think it just gives you a perspective of what is achievable with all these discounts. Certainly, we also have one-off discounts and campaigns every now and then, which also help towards this goal of achieving lower fees. And I think it basically gives an opportunity to everyone to start investing very, I would say, well, as I said, and to have a good quality portfolio, a user-friendly application, and very, very low fees.
Exactly. Low fees, thinking about taxes when setting it up, right? And having an investment strategy that has been verified by decades of data to work over the long run rather than speculate. And then maybe one last minor point that I would like to make about robo-advisors rather than direct investing, when many people ask. I also think it's important. And when you think about the developments of the recent years, where there has been a large decline, and then over the last year, especially towards the end of 2023, a sudden recovery, it's important to avoid emotions and avoid speculations when you're investing over the long run. You will have doubts when starting out on your investment journey. I had, given the extent and of the decline that was there in the stock markets and also in the bond markets. It was unusually correlated. So it's important to avoid selling off your investments when it's in a decline, because usually, or always in history, a recovery has come in the global stock market. You just have to wait for it. And when you sell it off when there is a decline, you will realize a loss and you will miss the recovery. So that is often the story why many investors individually become unsuccessful, because sooner or later they make emotional mistakes by making active management choices about their investments. And when you invest through a robo-advisor, where you just have a standing order and you cannot care about your investment, essentially freeing up your time to do your hobbies or do the job you like or be with your kids, whatever is better than thinking about money in free time, then you're also avoiding having to come to the brokerage account and buy something each month there. That is when the ideas about speculation come to your mind. You're like, should I buy this month or wait because it's too high?
Yes, I think this is maybe something that we didn't mention earlier when we were talking about the differences between active and passive investing. But exactly, I mean, this emotional part is very, very important.
Exactly.
And normally we say that the emotions are the biggest enemy of investing, while the time is the best friend of investing.
Exactly.
So this is where this passive and active investing really show you, different paths of how to achieve something or how easy or how difficult it can be, but basically taking away the emotions. It's all, I mean, this is what passive investing is all about, and having it simplified in an app and through this kind of investing platform like basically intelligent investing is helping you to become a good investor. I think we say that dead people are the best investors, and the second best are the ones who forgot about their accounts. So this is exactly what Šimon was talking about, not checking your app too often, not looking into all the world news, predicting all the catastrophes and the wars and this and that and everything that's going on basically every day. The history has proven that people always go over all these things and produce, and the economies develop. So in long run, all these hiccups, even though sometimes they sound very scary and can cause emotional response, like withdrawing from your let's say long-term goal and basically ruining it. Achieving it, so ruining achieving good pension or something like this. Yes, if you withdraw based on emotions. So this is why passive investing is a good solution for everybody, because it takes away this component of from you. This is also why we allow only one investment strategy change for free yearly, only because we don't want people to become too active. Yes. So basically we believe that once you have this initial questionnaire and you set your account, maybe in the long run, obviously learning more and educating yourself more and having more experience, there is a possibility that you want to adjust something in your strategy, but it cannot be on monthly basis or something like this. Yeah. So I think this is all from us for now. Thank you very much for joining. I hope we have brought intelligent investing a little bit closer to you. We are hoping to see you next time in one of our new podcasts again.
Thank you for listening. Bye-bye.
Bye.